Welcome back to the channel, and if you're new here, welcome. Today's video is one of the most comprehensive financial breakdowns we have ever put together. Over the next hour, we are going to walk through three of the most important pillars of building wealth in 2026: stock market investing, real estate, and personal finance fundamentals. Whether you are just getting started on your financial journey, or you are a seasoned investor looking for a mid-year portfolio checkup, this video has something for you. We have pulled the latest data, market research, and expert insights so you don't have to. Grab a notepad because you are going to want to take notes. Here's what we are covering today. First, we are going to do a deep dive into the stock market. What's moving, what the top performers look like right now in June 2026, and how to think about your portfolio in a high uncertainty environment. Second, we are going to break down the real estate market, whether it's better to buy or wait, what mortgage rates are doing, and where the real opportunities are hiding right now. Third, we are going to walk through the fundamentals of personal finance and budgeting, including why 69% of Americans are still living paycheck to paycheck despite claiming to have a budget, and what you can do to break that cycle today. Let's get into it. Let's start with the stock market. The S&P 500 has shown mixed performance year-to-date in 2026. While some sectors have absolutely exploded, others, particularly a number of high-growth tech darlings, have pulled back sharply. That is actually the sign of a healthy, rotating market. In the post-pandemic era, we saw massive multiple expansion in growth stocks. Companies that had never turned a profit were valued as though they were going to dominate the world. Then came rising interest rates, inflationary pressures, and now we are in a period where value, fundamentals, and actual earnings growth are back in fashion. According to data from Bankrate and TradingView, the S&P 500's top performers year-to-date in 2026 include SanDisk Corporation, up an extraordinary 172.8%, Texas Pacific Land Corporation, up 75.8%, Moderna, up 68.6%, Generac Holdings, up 64.8%, and Corning Incorporated, up 63.4%. Now, let me also show you the worst performers. Intuit is down 45.6%, AppLovin is down 44.3%, Gartner is down 42.1%, Workday is down 40%. What do you notice about that underperformer list? Most of these are software as a service or fintech companies that traded at extremely elevated valuations during the low interest rate era. This tells us something important. Valuation still matters. Never pay up too much for growth, no matter how exciting the story sounds. Let me give you a framework for thinking about your portfolio in this environment. Step 1. Assess your time horizon. If you need this money in less than 3 years, it should not be in the stock market. Keep it in high-yield savings, money market funds, or short-term treasury bonds. Step 2. Check your diversification. If more than 20% of your portfolio is in any single stock, you are taking on concentration risk that most investors should not carry. Step 3. Think about sectors, not just stocks. The sectors showing strength in 2026 are basic materials, energy, industrials, and healthcare. Align your sector exposure accordingly. Step 4. Reinvest dividends automatically. Research consistently shows that dividend reinvestment accounts for a significant portion of long-term total returns. Step 5. Contribute consistently. Dollar cost averaging, investing a fixed amount regularly regardless of market conditions, removes emotion from your investment decisions and ensures you buy more shares when prices are lower. The stock market in 2026 is rewarding companies with real earnings, strong fundamentals, and exposure to durable secular trends. Stick to quality, think long-term, diversify intelligently, and do not let the noise of daily market movements shake you out of a sound strategy. Now let's shift gears and talk about real estate, one of the most emotionally charged topics in personal finance, because for most Americans, their home is their largest asset. Here is the headline for June 2026. The market is normalizing. Not crashing, not exploding. Normalizing. And in a normalizing market, the advantage goes to people who understand the data before everyone else does. According to Redfin, Americans needed to earn $116,785 per year to afford the typical U.S. home for sale in April 2026. The typical U.S. household income is approximately $29,000 below that threshold. The average American family cannot afford the average American home. That is a structural affordability problem that has been building for years. The Federal Reserve held rates steady at its April 2026 meeting, maintaining the target range of 3.5% to 3.75%. Fannie Mae projects the 30-year mortgage rate will average 6.3% for the full year 2026. If you are waiting for rates to return to 3%, you are likely going to be waiting a very, very long time. However, here is the good news. Inventory is coming back. Total home sales are projected to reach 4.85 million units in 2026, up 2.1% year over year. There were 46.5% more sellers than buyers in April, which means buyers have leverage in most markets. The frozen market of 2023 and 2024 is gradually thawing.
Let me give you 4 specific things to look for as a real estate buyer in this environment. 1. Homes that have been sitting for more than 30 days. When you see a home sitting for 30, 45, or 60 days, that is a negotiating opportunity. You can often negotiate 3 to 7% off the list price, seller concessions toward closing costs, or repair credits. 2. Listings with price reductions. A price reduction is a seller telegraphing that they are motivated. This is where deals are made. 3. New construction with builder incentives. Many builders in 2026 are offering rate buydowns, free upgrades, and closing cost assistance. In some markets, builders are effectively subsidizing your mortgage rate down to the low 5% range. 4. Markets where inventory has returned above pre-pandemic levels. Markets in Texas, particularly San Antonio and Austin, have seen inventory recover significantly. Parts of Florida have seen inventory surge. Know your local market. Should you buy in 2026 or wait? My honest answer is it depends on your personal situation, not on market timing. If you have stable income, a 3 to 6 month emergency fund, a down payment of at least 10 to 20%, good credit, and you plan to stay at least 5 to 7 years, buy when you find a property that makes financial sense. The market is not crashing, but the best deals go to people who are financially prepared and ready to move when the right opportunity appears. Now we get to the foundation of everything: personal finance. Because here is the truth. It does not matter how good your stock picks are or how perfectly timed your real estate purchase is if your personal finances are a mess. Let me hit you with a statistic that should shock you. According to Debt.com's 2025 annual survey, 69% of Americans are living paycheck to paycheck, despite 86% of them claiming to have a budget. And according to NerdWallet, 83% of Americans who have a budget admit they still overspend. The approach is broken, not the person. The solution is values-based budgeting. Pull up your last 3 months of bank statements. For every single expense, label it as one of 3 things: love it, need it, or why am I paying for this? Your love it expenses stay. These bring you genuine joy. Your need it expenses are non-negotiables. Your why am I paying for this items get cut immediately. Most people find 3 to 7 expenses in this category: gym memberships they don't use, streaming services they haven't logged into in months, forgotten software subscriptions. Cutting these does not hurt at all because you weren't getting any value from them anyway. For a simple framework, use the 50-30-20 rule. 50% of after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. Before you invest a single dollar, build a 3 to 6 month emergency fund in a high-yield savings account. Without it, any unexpected expense forces you into high-interest debt, and high-interest debt is wealth-destroying. Let me share the most powerful example of compound interest I know, because it illustrates why starting early with retirement savings is so critical. Sarah starts investing $500 per month at age 25, earns an average annual return of 8%, and stops at age 35. She only invests for 10 years, contributing $60,000 total. Mike starts investing $500 per month at age 35, earns the same 8% return, and contributes all the way until age 65. He invests for 30 years, contributing $180,000 total. Who has more money at 65? Sarah does, by a wide margin. Despite investing 1/3 as much money, Sarah ends up with approximately $1.2 million. Mike ends up with approximately $745,000. That is the power of starting early. Time is the most valuable asset in investing. More valuable than picking the right stock, more valuable than timing the market perfectly. If you have access to a 401k at work, at minimum, contribute enough to get the full employer match. That is a 50 to 100% instant return on your money. If you are self-employed, open a Roth IRA. In 2026, you can contribute up to $7,000 per year. The Roth IRA grows tax-free, and qualified withdrawals in retirement are completely tax-free. One of the best wealth-building vehicles available to ordinary Americans. And finally, automate everything. The moment your paycheck hits, automatic transfer should fire. You cannot spend money you do not see. Set up your automated transfers today, even if it is just $50 per paycheck. The amount matters far less than the habit.
Let me bring everything together with 5 key takeaways from today's video. Takeaway 1. The stock market in 2026 is rewarding quality. Stocks with real earnings, strong fundamentals, and exposure to secular trends are outperforming. Stay diversified, contribute consistently, and do not chase speculative stories. Takeaway 2. The real estate market is normalizing, not collapsing. Buyers have more leverage than they did 2 years ago. If you are financially prepared, stable income, emergency fund, good credit, 10 to 20% down payment, 5+ year time horizon, this can be a good time to buy strategically. Takeaway 3. Your personal finances are the foundation of everything. Before you invest in stocks or real estate, get your budget under control. Build your emergency fund, eliminate high-interest debt, and maximize your retirement contributions. Takeaway 4. Automation is your best friend. Pay yourself first automatically. Invest consistently. Reinvest dividends. The less emotional your financial decisions are, the better your outcomes will be. Takeaway 5. Start now, regardless of where you are. Whether you have $100 or $100,000, whether you are 22 or 52, the best financial decision you can make today is to start or to improve what you are already doing. That is it for today's deep dive into the 3 pillars of financial success in 2026. If you found this video valuable, please hit that like button and subscribe to the channel. Drop a comment below and let me know which of these 3 topics you are most focused on right now. Until then, take care of your money and it will take care of you. I'll see you in the next video.